Welcome to The Pit. I'm Iggy, forensic investor and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Now let's get into today's numbers. The headline numbers might tell you that DBS is sitting at a $57.63 valuation with a 4.59% yield, but forensic tracking reveals a different reality. Today, we are tearing down the facade to show you exactly what is cracking beneath the surface. In today's volatile market, the distinction between a secure sanctuary and a perilous yield trap can be decided within a single trading session. For Iggy's elite investors, immediate access means seizing these critical moments before the market shifts and the institutions price them in. Let us look at how this forensic framework applies to your portfolio on the next slide. This is where you decide if you want to remain retail liquidity or become the analyst. Iggy's elite investors gain an unparalleled advantage with 0-day forensic breakdowns, full red zone watchlist access, and institutional-grade cheat sheets. For just 9 Singapore dollars a month, less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity. Let us pull up the numbers on the next slide. Opening up the market snapshot for the 7th of April 2026, the Straits Times Index is trading in a tight range between 4,975 and 4,987, sitting approximately 17% below the 6,000 forensic milestone. Over in Hong Kong, the HSI closed down 0.70% at 25,116.53. Let us pull up the first major name on the block on the next slide. Our first audit brings us to Singapore Airlines, where operational excellence is actively masking a bleeding balance sheet at the associate level. The core concern is a massive earnings drag stemming from their 25.1% stake in Air India. The slide shows their share of associate losses has hit a staggering 178 million Singapore dollars. We need to peel back the 5 layers of this specific structural headwind on the next slide. Breaking down the 5 layers for SIA. Layer 1 shows this 178 million Singapore dollar loss is an increase of 163 million Singapore dollars. Unlike SATS, which is actively paring down its WFS acquisition debt, SIA is watching its M&A burden expand. If aviation fuel costs spike by 10%, the combined pressure could push their forward dividend yield well below our strict 4.7% hurdle. For a 55-year-old in Tampines relying on these dividends, this shifts SIA from a perceived sanctuary to a strict watchlist trigger. My unfiltered take comes on the next slide. The market loves to price Singapore Airlines purely on passenger load factors and post-pandemic travel momentum. But when you carry a stake in an asset that wipes 178 million Singapore dollars from your bottom line in a single quarter, you are a holding company subsidizing a massive turnaround project. SATS learned this the hard way. You simply cannot pay dividends with load factors. You pay them with retained earnings. And right now, Air India is drinking your yield straight from the fire hose. The data tells a different story for the infrastructure sector on the next slide. Our second audit triggers a formal gearing alert on Keppel Infrastructure Trust. The headline dividend yield looks incredibly fat at 7.58%, backed by an approximate 4.51% debt cost. But they are carrying a confirmed net gearing of 38.7% alongside an ICR of 7.6 times. Retail investors see the 7% yield and hit the buy button, blind to the structural leverage required to sustain it. We have to unpack exactly why this leverage profile is so dangerous on the next slide. Running KIT through the 5 layers. Layer 1 acknowledges that the 7.58% yield clears our 4.7% hurdle. But Layer 2 shows the 38.7% gearing sits stubbornly above our 35% hard limit. Compare this to an industrial peer like Claire, KIT is already approaching the 40% ceiling. A 10% upward shift in the SORA curve would erode that 7.6 times ICR, directly threatening the cash distribution pool. For an income investor in Ang Mo Kio, that yield comes with structural refinancing risk. The forensic verdict is on the next slide. Everyone loves a 7.58% yield until they see the fragile scaffolding holding it up. Keppel Infrastructure Trust is hovering close to the 40% ceiling with no comfortable margin for error. A 7.6 times ICR looks comfortable today, but that buffer evaporates the moment debt rollover meets a higher for longer SORA environment. This is not a defensive infrastructure play. It is a leveraged bet on interest rates, dressed up in a distribution statement. We are shifting over to the United States commercial space on the next slide. This brings us to a massive gearing alert for prime US REIT. Management is parading a new lease to offer optical relief, pointing to a portfolio occupancy of 82.7%. But look at the capital structure. Aggregate leverage is sitting dangerously at 45.0%. Their debt headroom is down to just 144 million US dollars, carrying a 5.4% cost of debt. Let us map this out forensically on the quadrant on the next slide. Mapping prime US REIT on our 5 layers. This trust completely shatters our 35% safety ceiling with its 45% leverage. They are staring squarely at the debt wall with incredibly thin buffers before hitting the 50% MAS regulatory limit. If United States commercial valuations drop by another 10%, that leverage will be pushed straight into the regulatory cliff, forcing a distressed equity fundraising that will instantly dilute net asset value. For an SRS investor in Jurong East, holding this means accepting extreme dilution risk. Let me clarify the math on the next slide. Getting excited about a single new lease when aggregate leverage sits at 45.0% is like squeezing through the closing doors of a train that has already left the tracks. The 50% MAS limit is not a target you aim for. It is a sheer cliff edge. With valuations still facing pressure, they are exactly one bad appraisal cycle away from a distressed equity raising. The forensic math tells you everything you need to know about where this is heading. We are issuing our final red zone alert on the next slide. We are issuing a strict red zone alert for Monte Pacific. Management is doing a lot of shuffling, but it is a complete distraction from a balance sheet that is technically insolvent. Total debt is sitting at approximately 1.05 billion US dollars, while total equity is a negative 618 million US dollars. To make matters worse, EY has issued a formal disclaimer of opinion. The forensic verdict is unambiguous. This is a capital preservation situation, not a recovery thesis. We will break down exactly why this fails every test on the next slide. Looking at the 5 layers for Del Monte. The negative 618 million US dollar equity, coupled with the EY disclaimer of opinion, completely obliterates any historical benchmarking. It fails the basic mathematical test of a going concern. If lending conditions tighten, the inability to roll over its massive 565 million US dollars in short-term borrowings will force forced liquidation. For anyone holding this in their CPF investment account, this registers as a red zone trigger. Here is what the balance sheet is actually saying on the next slide. Corporate reshuffles mean absolutely nothing when the balance sheet is mathematically broken. Del Monte is operating with confirmed negative equity and carrying an auditor disclaimer of opinion. That is not a turnaround narrative, that is technical insolvency dressed up in a polished press release. Retail investors holding this are not investing. They are simply providing exit liquidity for the creditors. It is like buying a house brand tin of beans and finding out the tin is completely empty, yet you still owe the cashier money. Let us shift to institutional chatter on the next slide. Looking at the analyst chatter through our suit filter, DBS recently initiated coverage on Nam Chong with a target of 1 ringgit and 59 cents. But our forensic logic overrides institutional optimism. The filings indicate a debt-to-equity ratio of approximately 50.8%, which aggressively breaches the Iggy 35% gearing ceiling. We simply do not chase market momentum into heavily indebted mid-caps. Before we hit the summary, remember that if you want the full watch list before the market opens, Iggy's elite investors get 0-day access. You can position yourself securely before the crowd reacts to these red zone threats. The link is in the description. Now let us look at the yield spread on the next slide. Looking at our watch list and yield spread, we calculate true value by taking the asset yield and subtracting the risk-free rate, currently sitting at 1.46% based on the 6-month T-bill. This gives us the pure risk premium. We must ensure that any asset we hold is adequately compensating us for the specific structural risks we just audited. Let us detail our absolute stress test floor on the next slide. I apply a conservative stress test floor of 3.2%. The 6-month T-bill has dropped to 1.46%, but I do not lower my standards to match a temporary market dip. The floor holds at 3.2% to ensure sanctuary assets can withstand a return to long-term average rates. Adding a mandatory 150 basis points of risk premium gives us our absolute minimum yield hurdle of 4.7%. We are moving to the final verdict on the next slide. The market is throwing optical illusions at us right now. Singapore Airlines is universally loved, but that 178 million Singapore dollar associate hole is real money evaporating. Over at Keppel Infrastructure Trust, offering an attractive 7.58% while holding 38.7% gearing is like waiting for an HDB lift upgrade while the cables are visibly fraying. We will cover the true danger names on the next slide. The true danger lies deeper in the market. Prime US REIT's 45.0% leverage is a glaring, blinking red light signaling an impending equity cash call. Del Monte is operating with confirmed negative equity and an auditor disclaimer. For a retiree in Bishan managing SRS funds, you simply cannot afford to finance these massive corporate debt walls. Are you buying genuine cash flow, or are you just providing liquidity to solve a sponsor's balance sheet problem? My final thought is on the next slide. The ultimate lesson today is that capital preservation starts exactly where the illusions end. Do not let headline numbers or newly announced leases blind you to the structural decay happening on the balance sheet. Iggy's elite investors received this forensic breakdown this morning, 6 hours before the public version drops. If you want that zero-day access to our institutional grade cheat sheets, the link to join is in the description. Protect your capital, audit the numbers, and stop being the exit liquidity for the market. I will leave the final legal disclaimers on the screen for the next slide. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.